How is everybody doing this morning? I hope everyone is well. I always start talking low in case you've been jamming out to some music and you have your volume on 11. Try not to deafen everyone whenever I come online. All right, so overnight, so this is sort of how I typically start out right away when I log on. First thing I do is I take a look at the overnight range, obviously, and what you can see is the market traded up overnight. For the moment, we'll just look at the 10-year, all the way to the 23.5, and now has pulled all the way back in, and is actually making new lows in the overnight session. All three markets pretty much doing the exact same thing. And your S&P, the opposite basically, was down a bit overnight all the way to this area, 1862, 61, and has rallied a bit back to 1880. So what I typically take notice of first are support or resistance points that are very, very obvious. So, for example, this is the 10-year, and I backed it up a bit so you could see it from yesterday afternoon. Right in here is where the market, this is where we left off yesterday, basically. It's where it hit 12 over and over again and didn't get above it, right? And then eventually pulled back in a little bit to around 9, 8.5, and then went back up to 12, and then just hung there for got a little higher at 14, but then closed out right in that area. So we're already below this. It's trading right now around, as you can see, it's trading at 10.5, 10.5 by 11. So where is our first logical, support we're going to do for each market? So in the 10-year, it's obviously right here at 8.5. That was a big point. That was the top here, the bottom here, the bottom here. So 8.5, and then of course 5.5, where you guys made some good calls yesterday. So those would be our first two supports. And then really the next one, in my opinion, is not down until the bottom, which would be around 29. So mark off 8.5, 5.5, and we'll call it 29 right in that area. So I just go in, make a quick note like S1 for support 1, S2 for support 2, and then way down here for support 3. Now, keep in mind, this may or may not, when we mark these numbers, they may or may not have any relevance. And I guess this is what I try to emphasize with understanding, reading the order flow, trading off the tape, Sure, you would definitely want to remember, hey man, a lot of size, or hey man, listen to me. A lot of size traded between 5.5 and 7.5 and 8. That was obviously when people speak about a heavy volume area, and I talk about being able to remember that. You can look on a volume profile chart. You can look at the market profile, traditional market profile chart with the A, B's, and C's if you want, and that would show you this. We were here all day yesterday, so we kind of know what took place, and I remember, that was obviously the spot where it turned around and rallied finally. But it was a very heavy volume area. It would make sense that it'd probably be a very heavy volume area as well. But which particular price is going to be the one that holds up is anyone's guess at this juncture in time. And none of them may hold up. It just depends on what takes place. But we do want to be aware that that was a heavy volume area and there was some support there. We already have our resistance laid out for us. I mean, overnight, this is going to be a heavy volume area here, and then obviously up around the top. Now, if we look at the daily, we can bring up a data box of our daily here. If we go back to this day, that's basically where we are, because what you can see is we surpassed the high of this day, which basically coincided with the high of yesterday. And we're already trading back down below it. And that's going to be 15. Is that what that was? Yeah, 128.15-ish, which makes sense. And that right there, look at that. It does, you know, I talk about technicals, but I mean, realistically, I mean, if you look at basic support and resistance on charts, I mean, people pay attention to those numbers. They do execute trades based off them. So if you look at that, that happens to be the highest volume area overnight in the 10-year. Coincides, sorry, wrong chart. Coincides with this day right here and where yesterday's high was, right? So that makes a lot of sense. So if we go all the way back to here, this will probably be our next real resistance. You're looking at 128.17 and a half. And I mean, market was already above it. So we don't really have resistance to the upside that we can mark off besides what's already been shown overnight. See what I mean? So that was, you know, the main point, but we've already seen that it's traded there overnight. It already went through it, and it's already come back through, and it's already down near the bottom. So the way that I view that is, at this juncture, rather than focusing on any particular price, I focus on the overnight volume buildups. So I would be looking for possible resistance here, you know, and then possible resistance anywhere in this area. It's anyone's guess. And of course, if it did happen to get back to highs, I mean, sky is the limit, really. It just depends on how things are trading. So not really much point in making notes as far as that goes, I don't think. With the ZB, if we go back, you know, we can see that it hung around 08 all night, which was just above here at 0405. So we'll mark it off at, say, 04. And then down here, where that volume was, that coincided with the 5 halves yesterday. So that was around 20. The bottom was 21, but it was really 22 to 24. So we'll make a note, you know, 23. So 04, 23, and then taking it all the way down to, say, 155, you know, 30, basically. So we'll make, you know, right there. And a lot of people wonder, do I need to have the exact precise number? This is where I don't think you do. You know, based on my experience, I mean, sometimes it does go exactly to the tick. Sometimes it's just within that general area. So having just a good idea that it was right around that price, you know, 345 or 22, 23, 20, 24 is basically what you need to understand. And be on the lookout whenever it reaches there. And then with the 5-year, you know, we're looking at about 7 3/4 right here. Looking around 5 3/4 right here. And then 1, very clear at the bottom. Excuse me. So right around here, and then all the way down here. Oops. And then we can mark off the last close, 14, 10, 7, and 17. And pay attention to where it opens at 8:20. By the way, somebody mentioned yesterday that, and I couldn't tell if someone mentioned there was a way that you could program the alert column in Jigsaw to identify the opening price. I don't remember who sent that. If the individual who sent that is here, if you can shoot me a note real fast, I'll look into that today. I don't know if that was meant that you could mark it in the alert column, or if it was actually, I was not familiar for a way for the alert column to actually track something and program it. But I know someone sent a note about that, and I ended up losing it over the course of the day, but I remembered reading it at some point. Since we have a little bit of time here, I mean, the market is trading at lows, but it's not really moving that much right now. A lot of people, they use this feature within Jigsaw. I'm going to show it to you real fast so you can see it. Let's see if they got it. Where is it at? Volume profile. Peter built in these things, point of control and value area. So people have asked me about that, right? So if you highlight point of control, that comes up as brown, right? And then if you highlight the value area, it gives you these areas, which are all just based on volume, where there's more value than others, supposedly based on the history of the volume. I do keep the view app highlighted because there are, people who trade off that. So decisions are made off that. I think that point of control and value area are actually very subjective. And while, one person may find value in a certain spot, another person may not, because they're working different types of spread orders perhaps, or different types of strategies. Not to mention, they often, as you see, they coincide with what is the highest volume area on the cumulative volume profile, which we can already see without that being highlighted. So that's the reason I don't have those highlighted. I think it's just, it's unnecessary color that also may distract you in some way and make you give a little bit more importance to a price or two prices that maybe aren't that important, and really your focus should be more on just the total volume and more on how the bids and asks and prints are behaving. That's my take on it anyway. Interesting. So someone says that the Jigsaw has done the open by itself since you've had it, huh? I'll ask Pete about that today. I'll look into that. It's an interesting feature. I didn't even know it was available. Someone else mentioned you might have to have the thing set for a pit session, which that would make sense. If your depth of market is set for the pit session and not the overnight hours, then yeah, that would make sense. It's going to show up, but I don't know, maybe there's another way around it. Anyway, we'll take a look at it. Okay, thank you for sharing. I appreciate that. I'll read the manual today. Haven't done that in a while. All right, and as far as news goes, we can just take a quick look here. It's Tuesday. So this red book at 8:55 typically has no impact whatsoever, but the Case-Shiller sometimes does. That's at 9, and consumer confidence also can move the market. That's at 10. Those are the only two things we have going on today. We have no speakers, no auctions. But there's a little bit of movement here. Now, with the market cranking down like this, the reason I haven't joined this party, A, I'm talking to you, trying to get everybody set up, but B, this pre-market action is a little bit, it's different than yesterday's, the way that it's behaving at the moment. Yesterday was sort of this run up that was on lighter volume, and it just seemed to be moving up quite easily. Unfortunately, what can happen here with this type of a move is every time, what you'll see here is that even though they're selling the bid, when it does go offer, you don't see sellers immediately hit the next price. Now, they have been moving it down. Obviously, it's been since we've logged on, or since I've logged on here. It's been a steady down move. They broke the overnight lows. I guess that was right around here. But it's like sell, 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 offer, sit, and then eventually, okay, sell next price. Sell, 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 offer, kind of sit. And that's what's happening here, for example, right? So they've already sold 2,839 into '09, but yet haven't been able to take the market offer there, or even print a one lot at 8.5. But you're also not seeing buy orders. Right, that's really the first time we've seen that. Buy orders finally lift 9.5s and take it bid, but it's very slow. And if you try to jump on those moves when it's slow like this, it's very easy to find yourself short of the worst price, basically, just like that. So you end up maybe trying to short 9s, and then you sit there for 2 minutes watching it go back and forth, but you don't even see a one lot hit 8.5, and then it goes bid, and then they just tick up, tick up, tick up. That's not happening right here at this juncture in time, but I know that's a real possibility with this kind of price action. And so I'm really cautious, particularly prior to 8:20 a.m. when it's this slow. It is moving, but it's very slow, and it's taking quite a bit of size to move through each price. So it was over 4,000 here, over 3,000 here, now 4,000 is here, and now over 3,000 here, right? So there's not been any of these prices where they've moved through on 800, 1,200 contracts, and then and then went right through it to the next two prices. So when I talk about like a pressure point type situation, you see it over here a little bit with the 30-year. It only traded 249 at 31 and only 198 at 30. And now we have 651 here and 814 here. So you have a little bit of a pressure point right there that you can see in the 30-year. But for the most part, all three markets are trading a decent amount of size at neat price. So somebody said my S1 stopped it. That's right, man. It's magical like that. But see what I mean? So we've traded 47.59 at 9, and finally all of us, 6 contracts hit into 8.5. But yet, in my mind, at the moment, that's not like really necessarily a buy signal, because it's not as though you have buyers aggressively attacking 9.5 yet, anyway. So it's the type of action, basically. This is more of what we saw yesterday going into the open. Was fairly unusual. I would say you don't see that type of action, but maybe pre-market, but once a week, maybe twice a week, but it's not an everyday occurrence. So this is a little more. This is not a little more. This is a lot more common, and actually, it's moving even more than usual. Like the sell-off that we've had since I logged on here. Typically, pre-market, it ranges quite a bit more, even between 7:30 and 8:30. You just get some back and forth within maybe a 4 or 5 tick range. Here's a question I could answer while I'm looking at this. Is the fact that bonds are lower relative to last close more so than the notes significant? Not really. It may prove to be significant over the course of the day, but as you can see, all three of them are basically doing the same things. That's what I talk about. So when all three products are all behaving in pretty much the same fashion, meaning they're all going down side by side, tick for tick, and all hitting more support in one area than they did in another area, right? So there's more contracts trading here than there were here. There's more contracts trading here than there were here. More contracts trading here than like in that price, If they're all basically moving in unison and seem to have the same amount of pressure across the board, you can trade them as normal. Now, what I would be concerned about on a different note would be if, let's say, the 10-year was pressing down right here at the lows, but the 30-year was actually still trading up here around 2.3. And the 5-year may also be like up around 10.2 or even 8.57 even. In that situation, I would be a bit more cautious about entering a trade, and in fact, I would be way less likely to go short because I would think that the 5-year and the 30-year may end up putting the halt on the momentum in the 10-year. And they may try to, like the 10-year may then come back up 3 or 4 ticks, but the other products may actually stay where they are. And the yield curve may change and come back in again. So the 10-year may catch back up with the other two products. And this is getting, into something that you'll understand way more with time and watching the treasuries. But it's really very simple. It's just what happens is, a quick lesson in it, is you have guys playing the curve, and so they might be buying 9s, selling 7.5 in the 5-year. That's called the fight. It's the 5-year against the 10-year, FYT. So they sell 7.5 and they buy 9, and the hope is that the trade works out in such a way that 10-year loses less than 5-year does when the moves occur, right? So 10-year ends up going up 3 ticks, but the 5-year only goes up 1 tick. And they're able to profit the difference in the curve in that based on how they have their strategy set up and how they have their contract ratio set up. So what can happen sometimes, which you'll notice, is like the 5-year, let's say, maybe trading 8.7, and then the 10-year is trading 9, right? So the 10-year would be at lows, the 5-year would be off lows by 3 or 4 ticks, and then over the course of 30 or 40 minutes, maybe less, maybe more, the 10-year will pull into 10, and uptick 2 ticks, but the 5-year will actually stay at 8.7, or only move up by 1 tick to 9. And so that gap closes and that spread changes, and that's how spread traders profit off the change in the spread. So you can learn to take notice of that and realize when people are playing the spread in such a fashion. And if they are, and you notice that happening, that's when you have to be really careful about getting too hyped up on any kind of a momentum move or like a wave, because that's probably not going to happen. What's going to probably happen in that area is a range will probably develop, and guys are going to be playing the spread within that range. So that's when I typically stop looking for breakout type trades to work very well. And I also stop relying on one product as a leading indicator. So for sometimes what I'm able to do is I'm able to spot a move in the 30-year or even in the Ultra Bond, which is the UB, which you don't see up here, but I have it on my main workspace. And I'm kind of looking to see what's going to happen. And then I see the 30-year tick down a tick and then maybe even print 2 ticks down real fast. And I go, and I'm already looking for a short, let's say. So I see maybe like a 30-year print like that, and then even 100 print into 27. And so I'll throw out an offer real fast at 9.5 to maybe see if I can get filled, depending on the situation, And I can use that sometimes as a little bit of a leading indicator and maybe get a good fill in the 10-year. And then if the 30-year ticks down again, I know I'm probably good, and the 10-year follows along. But if the 30-year doesn't tick down and ticks back up, I may be able to scratch my trade in the 10-year. Whereas if I was in the 30-year, I'd be in a losing trade. So I can maybe use a 30 as a leader and make trades based off that. But when I see the spread starting to diverge, starting to change. So 30 years here, 5 years here, and 10 years down here maybe, then I know that I probably can't rely on the longer term products to be a leading indicator. Now it's just sort of each product is on its own relative to the spreading which is taking place. And if I'm going to make a play, I need to be very aware of that and not be looking to get too much out of any one trade, because most likely they're going to range in that type of action. So hopefully that makes sense. And I discussed that, like I said, in pretty great detail in the starter video, spreading as it relates to scalping. So I would recommend watching that video once or twice. It'll give you a good feel for what I'm talking about. And some people like to look into spreading, because a lot of traders do spread. I mean, more treasury traders spread than scalp outright. I mean, that's for sure. But I also give my reasoning for scalping in that video over spreading. So it mainly just boils down to I've developed a way to effectively scalp better than I would scalping spread trades. And when I'm right in a big way, I like to get paid. I don't want to be hedged. And the markets move 10 ticks in my favor, and I only end up scalping 3 ticks out of a spread. But there are also pros to scalping. I mean to spreading. I just don't recommend it to most people. So the comment is it's more about where they are in relation to the profiles. Yeah, that's the way that I view it. I mean, you can also follow from the previous day, obviously. You can follow how the spreads are, how they've adjusted from the previous day if you wanted to do that. But what I found is if they're all moving in unison, it doesn't really matter. Even if the spread has changed overnight and has widened or tightened, coming into the open, if all three products are like we're seeing right now, if all three products are moving in unison, doesn't really matter. And you just saw it right there. So you saw the 10-year stop backs up one tick, the 30-year stop is backed up two because it's lighter volume, and the 5 years backed up two, actually printing three. So they're all moving pretty much in unison. 5 and 10 are just moving a little bit more tick-wise, but that's because they're lighter volume, in the 5 years and quarter points. So that makes sense. So yes, more in relation to the volume profile and the daily range. I think a quick cursory glance there is enough to give you a feel for whether or not things are out of whack. Somebody said, would the nines have been a good buy? Well, they would have been a good buy. Look at that. I mean, yeah, that's legitimate. I won 12,000 trade at one price and only 145 prints through it. But when the market's trading that heavily at one price, pre-market, it's not always that reliable. It's a little hard, pre-market when it's that slow because I've seen pre-market or normal market. I've seen 12,000 trade at one price, but if you don't see guys like hitting back into 9.5, you can't really tell what's going to happen there. So there are plenty of times I've seen 12,000 trade at one price and the market's dropped another three ticks past it. When it's really slow, it's hard to get a feel for whether or not buyers are actually going to support and buy the next prices up. You can get a much better feel for that when the market's busy and there's a lot of continuous volume. When it's slow like that and there are spread orders being worked to that degree and with that kind of volume, I mean, really, you can make the call. There's 12,000 there. I could buy it. But in terms of it being a great trade, that's debatable, in my opinion. As it is, I mean, it's up two ticks from that point, but that's hindsight. Like I said, I've seen plenty of times. I see 12,000 trade at one price and then the market goes through it. It depends on the context. But it is a good example of, they hit a wall and the market bounced a little bit. But let's say I don't have a lot of faith in that price holding up over time right now. We'll just have to see how things develop over the course of the day. And the way this is looking right now, it's not looking real promising in terms of action. Very, very slow. We have seen some movement in the ES that may help trigger some stuff down the road here. But for the moment, we have no news at 8:30 a.m. No numbers till the Schiller at 9, but that's not really a huge number. So we'll just have to sit here and see what happens. But right now, it's clearly a very slow market. I mean, even though the S&P has been rallying slightly, you can see it's also very slow as well here pre-market. Someone said, I think the pit open helps. I agree with that. Meaning, it's right there at 8:20 a.m. is when the market, uptick, two ticks. You're a little bit of volume coming in right there at 8:20 a.m. I agree. I think that helped the bounce a little bit there. which is why you're not seeing it immediately rally 4 or 5 ticks. Um, it's kind of a battleground at the moment. So again, I know questions are going to filter in all day. Little things like that, I can always, I glance at them and I can usually answer in the moment. Other stuff that requires a bit of explanation, um, we're going to hold off, until the end of the day. This question, I guess I should go ahead and address this because it gets to my point about something that I say a lot. The question is, what are you mostly waiting or looking for at the moment, and do you have a bias, and why? So the answer to that is I'm waiting for more volume. I don't have a bias of any sort right now. This market could completely stop at these prices, turn around, reverse, and go back up into this area of high volume, or this market could get hammered more and break through nines and drop all the way back down to 5.5 or beyond. Excuse me. I really have no bias whatsoever in terms of overall direction, and that's because I'm not seeing anything that indicates there's much interest. Now, the market did just sell off. From the time I logged on, it was around 7:40, 7:35 a.m., 7:40. So, it sold off from 13 to 9. So off the get-go, you would think, well, there's a downward pressure, which there was then. But now it's run into a wall, backed up a couple ticks, and there's clearly a lot of buying support in this area, right? So what I'm doing now, I just wait. I wait typically until I see an increase in action and volume. It's like 1,800 trade up, so what? Doesn't matter. Offer refreshes. But the offer refreshing also doesn't matter because nothing's selling back into 10. So you don't have, you don't really have a good indication that there are players in the game. Once again, we're back to that idea of players in the game. So right now, again, I like to use a poker analogy just because it's a very simple analogy and it makes a lot of sense. Let's say your normal poker game has 9 players in it, right now it feels like we have about 3 players. And guys are just swapping chips back and forth, basically. One guy loses a hand, the guy wins it, and then the other guy loses a hand and the guy wins his money back. And that's sort of where we are at the moment, I feel. Volume is being moved, but it's being moved very slowly. And at the moment, there's nothing to really give me an indication. Based on what I look at, I don't have... I'm not seeing any clues or indications that the market's going one way or the other. I don't have a call. And personally, I don't really think there is a call here. Especially now. I mean, it's one thing to make a call to join an iceberg or join a bid when 12,000 trades there. But once it's come off that price by 3 ticks, and now you're right in the middle. I mean, that was the breakdown from 12.5 to 9, and now you're back at 10.5, 11 dead in the middle, in between those two mini peaks there. Where is the edge? Where is the high probability trade? I mean, it's not there. So I just kind of wait. It looks like the S&P is trying to go for overnight highs. But again, whether or not it will achieve that, I mean, who knows? At any given price, a wave of sellers could come in and drive it back down 6 ticks. So I don't know. The question is do I look at profile from previous day session? What's my opinion regarding the previous day's VAH, VAL, and POC? I actually just discussed that at the very beginning today. Um, so it's right at the beginning of the recording today. But for the most part, I pay more attention to today's profile than yesterday's. And as I was discussing, if you watch a market enough, you begin to remember the areas where you had the high volume, low volume, right? So I know right away that we have a lot of volume between 5.5 and 8. I know we had a lot of volume between 12 and 11 yesterday afternoon, just back and forth. We had a lot of volume between 23, 24, 22, right? So, yeah, that's why those areas are marked. Whether or not they'll play a key role today sort of remains to be seen, and I like to apply more importance to what I'm seeing right now in the moment, and then that's sort of secondary. So in other words, if the market was to break down below 9 and then get into this area at 6, 6.5, 7, and maybe not even touch 5.5, but just get into this area where I knew there was high volume yesterday, and then all of a sudden I see buyers really aggressively attacking sellers, then I'm inclined to join the buy side. But I'm not inclined to join the buy side just because I know that was in high volume area yesterday. In the same way that you won't see me just working an offer out just because that's a heavy volume area on the upside. I'm aware that this is a heavy volume area. I'm also aware that it's a point that can be important, but I'm not going to be working a sell order at 15 or 15.5 unless there's something in the price action that confirms selling pressure. That makes sense? So again, this is the core information right here, and this is secondary, and then everything else is third, fourth, and fifth. Because this is what really clues you in to what's happening, and this is how you begin to identify the most prime entry and exit points. It's what helps you save ticks on an entry or even save ticks on a loss. There are times when you may enter a trade and think you have to take a 2 or 3 tick loss, and then immediately you realize, no, I'm on the wrong side. There's no doubt about it. And you blow out for a 1 tick loss, or maybe are lucky and get a scratch, and then maybe even go the other way. Reverse it up and go right against the trade that you just made. So that kind of information is right here. This just helps you spot points ahead of time. So we already know that, point, and we can be looking for support at those levels and know this much more likely, sort of like it was here. It's much more likely that you'll run into buying support at 8.5 or anywhere in this area than you will at maybe, say, 11, 10.5, which is kind of what happened there. That's how it's useful, I think. You begin to realize, even like in this area right here, for example, so if the market's pressing up, it would make far more sense that you'll have more selling pressure at 21 to 20 than you would at 18.5 and 19, simply because of the fact that there was far more volume that traded at those prices. So if you're looking for a sell trade, you probably are not going to be looking to put your sell trade out at 18.5. You'd be looking more to trade somewhere between 19.5 and 21. That would be dependent upon the overall action, but that's how you can use that to your benefit. It gives you a heads up on where you should be looking, and can also help to keep you out of trouble. Bad prices. just by very clearly showing you that, hey, 14.5 wasn't the price, 15 and 15.5 were the prices. So just go ahead and let it get through 14.5 and then see what happens at 15, 15.5 and maybe try to work a sell order there instead. By the way, let me point this out because this can happen during the training sessions. If I had bought at 9, because this is where debates come in, and this is, I just want to give my feedback on it, and everybody has their own opinion. If I had bought at 9 and taken this market to 12, it would make it look as though I made a really good call. You know, the thing is, at that particular juncture in time, even though I could see it was hitting a wall, based on my knowledge of treasuries, it's very hard to make the call that that's a high probability type trade. In retrospect, of course, it looks beautiful. You know, it would have worked very, very well. But when things move this slowly, you know, sometimes, again, it's not really it's not as though buyers, there was a group of net buyers who, you know, were sitting out there necessarily thinking that they were going to press the market all the way back into the range. What it becomes is more of that self-fulfilling prophecy. So you have, heavy buying, which does stop the market. But even when that was happening, if you go back and watch it on the video, the offer at 9.5 sat there forever. I mean, it wasn't as though buyers were aggressively attacking 9.5s and 10s and really supporting this area. What happens there is what I was describing a lot yesterday. It is the market goes lower because it's breaking overnight lows. As it's breaking overnight lows, you get sell orders. You get stop sell orders. You get programs. You get people playing the break. Eventually, it hits a wall. Now, there are times when that happens and it's busy, and I see an iceberg absorb or whatever, and I join the iceberg because I'm looking for the liquidation, because I know that it can happen kind of quickly, like the trade I made yesterday. But when it's that slow, what ends up happening is finally, a buyer eventually takes out 9.5, and then the market just sits there. And then as buy orders start taking 10, what happens is shorts from 11.5, 11, and 10.5 now also hit 10 to scalp out their profit. And that, of course, takes 10's bid. But then 10.5s just sit there. So it's not, like you have all this volume and this back and forth that is really quick. And it doesn't have to be quick. I mean, if you get paid, you get paid. But I wanted to explain that because it it can sometimes seem as though a trade like that, I missed out. Um, and in retrospect, I did, but there have been plenty of mornings when I've seen 12,000 sit on the bid, and then, and the offer didn't leave. That was kind of the key. Like the offer just sat there. All the offers just sat there. And so I see 12,000 trade, and a few contracts may print at 9.5 and 9. And then instead of doing what it's doing now, it goes the exact opposite way. It just goes down tick again, down tick, down tick, right? Um, so I just wanted to put that out there in case you're wondering why I didn't join that large order. I mean, it obviously technically makes sense. You have heavy buying. It's right at the number, support level here. It's also right at the support level in the 5-year. I mean, I would say under different conditions, I would have been contemplating that. If the market had been a little faster and had been a little bit more volume there, I would have been contemplating that trade to a greater degree. But that's why I didn't take the trade. As it turns out, it works perfectly, and it's a very good example of uh, technicals holding in the treasury market. Excuse me. But again, it's just sort of context for me. The context there was, yeah, there's a lot of volume absorbing, but it's so slow. I mean, I can't really make a call, and I feel like it was 50-50 there, honestly. I mean, I didn't really have an opinion that it was going one way or the other, as I expressed in the moment. Excuse me. And here's a comment, and I mean, I agree that the comment is, I think psychologically it was a buy. Uh, if you look at it with the price action and the fact that it coincided with the support level, and that's just it. Psychologically, I would agree that it was, because I was certainly sitting there thinking about it. It again comes down to kind of context and experience in the market. So there have been many days where psychologically I thought something was a buy, and then I got my bottom handed to me. You know what I mean? Psychologically, it did look good, and I stepped in front of a grind like that because I saw 8 or 10,000 contracts trade, and then it just kept going right over top of me. Um, so that's just me. That's why I didn't take the trade there. But as it turns out, like I said, it's a very good example of a size and a technical support level holding. It's actually quite a rally off that level. I'm pretty surprised that it came off that easily. Sorry, I muted myself. Um, Thank you for pointing that out. I had shared that question. I think I had myself muted. Um, I agree that psychologically that did look like a buy, and I was even thinking about buying it myself. And my issue is that psychologically, I've had lots of psychological buys and sells, um, and then been ran over. Because the price action wasn't really not the price action, but the context wasn't really confirming my opinion. Um, so it just sort of depends. But it was, like I said, it was a very good example of volume lining up with the technical and then actually working. Other guys would look at it as well. I agree. That's one of those things, though. Again, it's just about context. I mean, sometimes that's the trap. I guess that's where I'm going with it. You know, yeah, 12,000 were bought there, but 12,000 were also sold there. So there was definitely someone moving a lot of size and definitely on a spread in that area. So that's sort of the it's really one of the, I don't know if you want to call it a an art or a talent or even just a gamble. I don't how you want to say it, but is trying to determine those times when the volume is really cluing you into something, or when there's just a lot of volume there and you take a shot and it holds up where it doesn't. I mean, at least you didn't pick a bad price. You know what I mean? Not saying you personally, but at least if you are going to buy, or if I am going to buy, I will wait till I see the market hit a wall. I'm not buying at 10 half or 10 on the way down. You know what I mean? So that at least gives you somewhat of a better edge. You're picking a better price in terms of your entry. Whether or not that price is going to hold up under the context, debatable. But at least you pick better spots. Now here's what I want to show you guys. Notice how the 30-year has dropped all the way back to the low, yet the 10-year is still off the lows by a good degree, and the 5-year is off the lows by a very solid margin. That's your spread moving in a fairly big way, actually. So when I'm looking and see this big bid absorbing right here at 12, so that's where I don't look. A lot of people would say, well, I have an iceberg at 12. Do I join the iceberg? This is where I don't get involved with that iceberg, because the 30-year is all the way back to the low already. So I can see clearly we have spreading in a big way, right? So you probably have someone selling the 30, buying the 10, working large orders on both sides. Excuse me. So just because I see an iceberg of 6,000, I don't buy that iceberg at 12. I don't join that iceberg because I see the divergence in the spread. So, and the fact that the 30-year is at lows, kind of moving lower, would seem to indicate the markets could fall in here. But then again, right here, this is our support level in the 30-year between, say, 22 and 25. So this may make it a tough trade for the next 20, 30 minutes in here, unless steam really picks up one way or the other. Because what we may see now is we may see it actually reverse at one point. And what we may end up seeing is we may end up seeing the 30-year touch like 23 and then bounce back to 27, but yet see the 10-year possibly maintain at 11 half, and not really move, as those spreads get adjusted. So that's how you can take note of a divergence fairly quickly and try and make a better decision based on that. In which, in that case, the better decision would have been don't join that iceberg that's trying to support the bid there at 12, because that's part of a spread. So I'm going to line them back up across the board here and just let it sit there for a second, or let my center bars sit here so you can kind of see how each market behaves, and then we'll see if one is outpacing the other. Now, see, I'm not saying it's going to happen exactly like this, but I wouldn't be surprised to see the 30-year bounce like it is. See, it's bouncing like a 26 and maybe even print 27, but yet the 10-year may stay offer right here at 11.5. Someone's asking, so the volume at 12 is partly spreading. It's probably all spreading, actually. Well, there might be some HFT in there bouncing 50 and 60 lots off of it, but most likely it was an individual or somebody at a desk working a buy order at 12 while simultaneously working those multiple sell orders in the 30-year, taking it down. So they're either laying it off or they're putting it on. You see this? This is what I'm talking. So see how it's bounced back to 27, and yet 10 years still offer 11.5. So the 30-year has ticked up 3 ticks now above center line. 5 years ticked up 1 tick, and the 10-year is still offer 11.5. Hasn't even upticked. Hasn't even gone bid at 11.5. That is like a crystal clear example of spread action and your market's not moving in unison, right? So this is when I'm and now you have a big order sitting there absorbing. You see that? So for whatever reason, why it is that's the spreader's thing. For whatever, who knows why he's working his order, but that's one of the benefits sort of treasuries, and that's also why you have to watch all 3 of them. That's an excellent example of why you have to watch all 3 markets. And I realize, like, right now that seems so far beyond newer traders. Don't let it throw you off like you'll never be able to see that. You will be able to see it. Trust me, you'll be able to see it very easily with a little bit of practice. But that's why you have to watch all 3 markets, so that you can, because you know how annoyed I would be right now if I had bought 11.5s watching this pop 4, 5, 6 in the 30-year and I can't even get 1 tick out of it. You know what I mean? And I know from experience that kind of situation, you could be hung there, because if the 30-year only pops, say, 3 ticks, and you're trying to buy the 10-year at 11.5, and you can't even get it to go bid, which it is now finally, but you can't even get it to go bid, and then the 30-year tanks right to the low again, you don't even have the shot of scratching the trade. So that the 30-year pops 3 ticks, you can't even make 1 tick on your trade, and all of a sudden you're hung in a loser. And it's all due to that kind of spreading action. Now I take it back to 12.5, but you clearly could see that discrepancy in how it played out. That was a really great example. So it may not make a lot of sense to you right at this moment in time, but if you rewatch that, I'll even make a note of it on the trade recap. It'll become very clear what I'm discussing right now. It'll become very clear to you, and hopefully kind of help you understand why you should watch all 3 markets and how they can clue you into a few things every now and then. And see, that's also one of the great things about me teaching, at least in the treasuries, is you can see, in my mind, that's an advantage to trading treasuries, is that you do have 3 markets which are highly correlated, but yet do diverge due to the spreading. And so every now and then they can clue you in as a result of those spreads. But it also provides a good example because you can so clearly see the volume due to the liquidity, like the 6,000 that absorbed on the bid there at 12 or whatever it was. When you can actually see it very, very clearly in Jigsaw and in the treasuries because they're liquid, it gives you a little more insight into what's happening behind the scenes. So it's one thing for me to sit here and talk to you about how guys spread these futures or how they spread futures against cash. They buy the 10-year futures and sell the cash 10-year actual notes, and that's kind of, it lingers out there in the abstract for most people. But then when it actually takes place on the screen, it happens in such a way that you can very clearly see the volume. And then you clearly see how one product stays at center line, one product goes down 4 ticks, and one product maybe goes down 1 tick. And now all of a sudden, and then you see the iceberg absorb on the bid, and you go, oh, that's what he was talking about. Wow, that makes a lot more sense now. So it's nice to have the visual to explain what you try to explain without it. It's very hard to explain spreading without actually being able to see it in effect. And so do you see the 30-year had traded all the way, it was all the way back down at 26.25. So it's popped from 25 to 31, and yet your 10-year is still 12 half. 12 was where that original buy order was. So that makes me really cautious about entering into any type of trade right here at the moment. Mainly because I'm concerned, like I was saying earlier, it's funny, it's kind of adding up. I'm concerned that I can't use the 30 as a leading indicator for starters. So frequently, I'm sort of watching the 30-year to see if a few more, if they're just taking out one price up or one price down. I mean, it helps because the other markets read that. So now, even though I see the 30-year moving, it doesn't mean that I can rely on that movement to drag the other products with it. But if I try and trade the 30 at the wrong price, I might get hung in a 4-tick loss real fast because there's a spreading taking place here. So the 30-year may disintegrate 4 ticks, yet the 10-year may stay right where it is because the buyers are supporting in the spread. So it really throws off my game until I see them come back into unison. And start kind of keeping pace with one another again. Somebody asked, is the 5-year going into a pressure point? No, this is not a pressure point. Okay, so I can clarify that real fast. This is what I would call a valley. So if you look at the reading the cumulative volume profile and the momentum and pressure point starter videos, but a pressure point is more when a market is breaking one way or another, highs or lows, and as it's breaking, it sweeps through a price very easily, like we were watching yesterday in the S&P. That's what I was pointing out in the S&P. This is not a pressure point. This is just it's a valley in between this peak and this peak. Okay, but that's not a pressure point. A pressure point would be it was the 30-year had one, and it already filled in. And I don't remember where it was, but it was like the 30-year. Remember, I pointed out it broke 2 prices, and one price was like 249, and one price was 168 or something like that. And then it traded like 1,000 or 2,000. The next price is down. So then it came back in and filled in that pressure point where those 249 and 168 were, whatever they were. Um, this is not considered, this is just a lower volume area. And so actually, uh, due to the current spread factor, which I can very clearly see, I'm not looking to take a trade at the moment. I'm looking and kind of hoping that they come back in line with each other and start kind of moving tick for tick again before I fire. But yes, it would be more common to either see it's going to hold at 13 and 12 half, or going to hold at 10 and 3/4 and 10 half. That also happens to coincide with the last close. Or if it moves through there and gets to like 11 and 1/4, or gets to 13 half, 14, then I don't typically look to fade until it gets to 15, 15 half. You don't really have a coinciding large amount in the 5-year. There's more volume there at 12.7, 12.5, and then more volume here at 7.8. But the problem with playing in this area at all is unfortunately the spreading context. Like if I try to buy 13 halves, I can't do that with really any conviction, because I know the market may trade 14 and trade right back down to 12 half. It's like there are times when I would play a little bit of a break into a valley looking for it to maybe go to the next peak, but this is not one of those times. And it's mainly because of the spread factor, which I can see taking place right now. So I really want to see these markets come back into kind of an equilibrium and start moving tick for tick again, and see some signs of support or resistance that's just maintaining on one side. I mean, you can even see here, I mean, we're still trading. We're not really moving now. We're still at 12, 12 half in the 10-year, 12 half, 13, whatever. Now, what's interesting about today, excuse me, sorry. Whenever I talk a lot, obviously I get kind of worn out. That's why you hear me occasionally choking a little bit, getting rid of, clearing out my throat. Um, you know, Contrast this morning with yesterday morning. I think they've both been difficult, but yesterday I thought it was difficult because the volume was light. It was too thin. Uh, they were sweeping the 10-year on a few hundred contracts here and there, and it was much more volatile than it has been today, but it was on very light volume, and so it was a bit hard to get a feel till later in the day when it slowed down a bit. This is the opposite of that. There's really no volatility to speak of, much heavier volume, and clearly a lot of spreading taking place, which is also making it not conducive to great trading. But it's a good example of how each day can be very different, and how you just sort of have to come in and assess it for what it is. Sorry. I think some people had mentioned would I actually lean on that 3400, and the answer is no, given the context. I'm definitely not looking to sell 13 halves, and in fact, I think if the market presses 13 half and starts hitting 14s, it may very well get back to 15 half fairly easily. But this is sort of one of those. This is a kind of a trap area, really, due to how slow it is and the spread factor. I'm hoping that once the stocks open, it'll lend some volatility to this market. And yeah, someone mentioned that the ES is just as, it's very dead this morning compared to how it was yesterday. Exactly. I mean, the stocks do it too. I mean, they slow down and get tight, light volume as well. So, yeah, exactly. So all the markets are just sort of in limbo right now. The question is, so is playing a spread adjustment never a viable trade while the market's correct off the spread? No, it's not that it's not a viable trade. It's that it can just be very difficult to call, because what we saw down there, is that the 30-year was at lows and the 10-year was holding, but on a huge iceberg of 6,000, right? So the problem is you're not sure how it's going to correct. You're not sure if the 30-year is going to pull in and go up while the 10-year sits, or is the 30-year going to collapse another 5 ticks while the 10-year stays, or is the 10-year going to sell off 3 ticks and the 30-year just stay solid at one price? You know what I mean? Not to mention, it doesn't have to correct to the inside. It might actually blow out wider. So if you're looking, often it blows out a little bit and then comes back in, and blows out and comes back in. But in that situation, it would have been possible the 30-year could have broke lows, broke down 5 more ticks, and the 10-year still only moved by 1 tick down or 2 ticks down. And so the spread would have even been wider. So if you've been buying 30, selling 10s, you would have been on the wrong side because the spread was blowing out wider. So it just kind of makes for a difficult read. Yeah, naturally, if it's to come back in, then yeah, you would be like, if I think it's coming back in, I'm going to buy 30, sell 10, right? And then as it stands right now, if you had the right ratio on, you'd be making money because the 30 years popped up, 10 ticks, and the 10-year has only rallied. You could have, sold 12s, 12 halves, has only rallied 2, 3. So, but it didn't have to come back in right away. It could have easily widened a bit more before that happened. And that's always what spreaders are trying to identify. They're trying to figure out, Spread traders lose just like everybody else. You still have to be right on the call. So see right here, even though they buy it and they bid it heavy at 13 half, 355 print, that order doesn't really go anywhere. Most of it's still there. Someone's working 2400. Even if they take that 2400, I don't know how many more orders are going to actually want to buy 14 halves, knowing that there's resistance at 15 and 15 half. So this is where that anticipation factor comes in. I mean, it makes for a really hard read. I certainly don't want to be shorting as the market is rallying, but the fact that it's approaching a resistance point, and the fact that it's this slow, well, there you go. They wiped it. So that'll tell you something. All right, well, let's see what happens here at the next level of resistance. That would have been a quick 3 ticks. Anyway, that's why you don't lean on that price. It's not in the correct area, basically. Um, and it's also kind of why you don't really want to step in like right there at 13 or over there at 10 and 3/4. I mean, it's a hard call any way you look at it, but that's one of those trades that's definitely kind of like a suck you in trap trade. In my early days, I used to make those trades way too frequently. I would just kind of blindly rely on the large price holding, or holding like right here, and just get run over all the time. Um, so I don't really make those trades anymore. That's why I don't really make like pullback trades. It's really easy to get run over on any kind of a pullback type trade. I mean, you can see they're definitely hitting some resistance, at these prices. Clearly, much more. Again, notice that's a pressure point on the upside. You know what I mean? They buy 26.63, it instantly triggers buy orders, and only 501 trade at 14.5, right? And then it hits some size at 15, 15.5, and 16. But it's a perfect example of what I was talking about earlier, which is you can use these to help find better prices. So clearly, you wouldn't want to have a sell order working at the lower volume price. You would want to have a sell order working here or here if you were going to, if you're going to take the shot, take it in a logical place. Don't take it in a point that's a valley. That's a really good example of that. Is this, someone's asking, is this kind of like a suck you in long trade? I mean, yeah, I would view it that way. It could definitely progress beyond these prices. Um, I would think we would see some back and forth here. Sometimes this can be an area where, if it holds, you might be able to scalp out a couple ticks in the mini range. But if it doesn't hold, it'll get through pretty easy, most likely. Especially considering the S&P is dropping off. So now, also though, you can see like I'm a little more interested in playing. They all seem to have, particularly with that jump right there, they seem to have come back in line a bit in terms of moving almost tick for tick in the same direction. The hard part about these areas is you really have to, if it ends up being kind of a tight range, you really have to pick the right prices. You know, it's not like you're making a play necessarily to look for a reversal or something that, or a breakout that maybe runs 4, 6, 7 ticks. It's more of what prices can I catch to scalp 2 ticks real fast. You know, maybe three if you get lucky. Because it would make sense that this would bounce back and forth a bit right in this area. So we're going to see now, kind of what I'm looking for basically, obviously, in that kind of an upwards move, besides maybe, a mini scalp on the short side, and that's possible too, but I'm looking more for will they support this now in this area now that they've made it into that area again. Um, we have a situation now where the buy side seems to really be holding up without allowing it to fall back into this little valley right here, and kind of basically support above the close here and above the close here. Um, I think when the equity is open, we might we might see a bit of action. I mean, we're already seeing a little bit, but I thought it was really tough to call in that spreading scenario. But that could be conducive to starting a little bit of action. And if the equities start moving, I think we're going to see the treasuries move a bit as well. Um, so on that note, I got to step away for just a couple minutes. So I'm going to step away real fast and before the equities open up. So I'll be back in like 4 or 5 minutes. Yeah, so you can see like these markets are jumping a bit based on and I think the like once again stocks are going to play a bit of a role today. Yeah, there's a little bit of a refreshing order there, but I'm not really inclined to stand in front of this up pressure. Um, I'm actually looking to go with it, which should have already been on board, but I had to take a break. Um, so 1 minute till equities. So I usually, if I'm not in a trade already, I usually just go ahead and wait and see how the initial open takes place at 9:30. I think it'll make sense to have a little bit of back and forth right here, but I'm basically trying to eye without, I don't. It's very easy to get caught up in wanting to be involved. Um, so I'm trying not to make a bad decision here. Uh, and when I'm watching, it's kind of looking at these big offers that are sitting out in the five. They're not huge, but they're there, and I'm wondering if those will sort of act as magnets, and if they do, eventually, if the market gets to that level, if the 30 year, for example, will just shoot right through where the last close is, and the 5 year will pop right past 14 to like 14 quarter 15. Um, by the way, there's a really good example of seeing kind of like what an iceberg looks like in the S&P stopping the market temporarily anyway. Because I mean, obviously, I do expect, you're always expecting a bit of chop back and forth, but the reality is these markets broke overnight lows, pressed all the way back up, pressed pretty easily through this area and through this area, you know, and now they've managed to press through this area as well, and kind of in that area in the 5 year. So while there may be some short, small scalps that can be taken here and there, um, like short-term sell side scalps, I mean, I have to pretty much maintain a long bias, overall, and until something convincingly demonstrates that sellers are going to be able to put the halt on this, and same thing obviously like with the stocks. I mean, like the buyers are going to have to hold the stocks up in order for, I think, for the treasuries to fall back in any kind of significant way. See, right now, and I am definitely, I mean, like I said, I'm buy side biased, but what I'm not seeing here at these prices is what we did kind of see right there, which was just really solid buying support and kind of aggressively attacking offers right down here. And now it seems to have paused a little bit right in this area. Yeah, I don't want to step in front of a train here, but it feels as though you have some selling action up here that might pull it in just a little bit. Oddly enough, I don't really like the buy here at the moment. I feel like I'm going to be the last guy of the party. That's going to slow down before it actually gets to the high. Yeah, I don't know, guys. This is just basically how you sit there and watch something happen without doing anything. Every single price at this point looks like it's too far gone to me. Which of course it's not, obviously, as it keeps pile driving higher. And I don't normally look to short like right where highs are because it's usually a bad idea. Um, but I don't know that they're going to break this on this particular run. Yeah, I don't really know how to explain that at this particular juncture. I can explain it a little bit more in the recap. Um, I mean, obviously, in retrospect, the person could have made a buy call there, any price. But as it like is approaching the highs, there was just a lot of volume absorbing at 21 half and 21, and That's exactly the kind of spot where it's easy to get sucked into buying, and then you get hung for 3 or 4 ticks and you don't know what to do, which is what I was concerned about doing. Um, if they actually get through there, I mean, I won't be contemplating a short at all. But right at that level is it seems to be struggling a lot. So at that level, I mean, right here at 21 half and 22, I think that, of course, I'm liable to get hung there too. But if it hits 22s, 22 halves, I think they'll go for highs. I think the 5 year will go for highs also if they actually get through this point. But right when it approached it, it seemed to run into a bit of a wall. Oh, gracious. But see, then I watch them jump on it, and I see a big bid like that build. So that 30, 32, 3,300 is building, and oftentimes that's like a big build up to try and dump off more size. It's weird. Yeah, it's almost like a short term pump and dump. This is a really not again. I mean, I don't know how to say it. There's like sometimes when I have a good feel in it, and there's sometimes when I don't, and this is one of those times. It's obviously, I mean, you have a market that's just barreling higher overall, but right here at this particular juncture, and you see it pulling back in again. It it hit this wall, and then they bid it real fast, and then you could see this bid pump up to over 3,000. Anytime I see someone bid up real fast and pump the bid to 3,000 plus, I'd never want to get long. Because I know that often that's like a quick pump and dump type situation where someone bids, they buy, they bid heavy, and they're working the offer 1 and 2 ticks higher. And then as soon as they get filled, they pull the bid, and the market does exactly what it's doing right here, which is falling back in. And so it clearly makes it very difficult to try to do any kind of a go with breakout trade. That's just one of those. That's one of those spots where I've been trapped in that kind of action also many times. and I try to avoid that now. So oddly enough, the way the market, I mean, there's volatility here, but the price action overall is very hard for me to read. I don't. I mean, I had the right read there in terms of it, pumping, dumping, pulling back in, but it makes it difficult because even though I sort of want to take a short trade in that area, it's like, man, do I really want to step in front of this kind of power? You know. Um, Now there's not much there. This is a different story. The truth is to play these types of situations. If you want to play them, it usually requires sitting through some chop. So on the upside, for example, I mean, if you really want to take a shot at market breaking highs, I mean, you have to buy somewhere in here. But the downside is if you're wrong, you're going to end up losing 4 or 5 ticks. Um, but once I've seen that kind of size absorb and continue to just hit bids at 22, 21 half, and 20 or 21, the idea of stepping up to buy a breakout at 22 or 22 half is not very appealing. Um, so now what I'm trying to do is see if I can find this, but it's not very reliable. But right now, maybe as it pulls back in here, there'll be a spot somewhere down here where buyers hold fairly well. Maybe I can get a buy side trade that rallies back up to at least 21 half or 22. But sometimes that can be a trap as well. You think you're waiting for the pullback to come back in, and you try to jump on board with it, and instead you get run over by 3 or 4 ticks pretty easily. Fast action is good if it's sort of clearly in one direction, but when you hit a wall like that in the fast action, and all of a sudden the market's pulling back in 4 or 5 ticks, then rallying 4 or 5, then pulling back in 4 or 5. Now you're in a bit of a danger zone area because it is moving fast. And if you get on the wrong side, you know that it can drop against you 4 or 5 ticks pretty quickly now. Whereas before, earlier in the day, you can take a trade and sort of feel it out, maybe. If it doesn't go, it doesn't go, and you lose a tick or two. This is a bit of a different situation. So I think everyone's looking for a run to new highs, but the problem is sometimes because everyone's looking for a run to new highs, there's no one actually making the run at new highs. You know what I mean? Everyone's thinking the same thing. Not everyone, but most of the people are thinking the same thing. But unless there's somebody on board to make that happen, it doesn't happen. And sellers can sense that, and they end up bringing the market back in and doing the classic shakeout type scenario. Excuse me. We also have consumer confidence in 2 minutes, 1 minute. Yeah, man, pulling those short trades right there is really hard. I mean, it, it it looks right because you can see the absorption and the back ticking at those prices, but you also know you're stepping in front of a train. So I have a much more difficult time taking a short trade right at the level rather than after. So if the market has already broken to new highs, and now I think we're coming up on a liquidation possible point, right? Then I'm way more inclined to take a short trade. I'm like, okay, probably some liquidation here. I can see big offers above me. I'll step in front. But when it's right there at the tipping point, where I know that if it goes through, the market's liable to sweep 4 or 5 ticks on stop orders. Even if I see the seller slamming bids, I have a hard time stepping in front of that kind of power. It's just so easy to get run over if the buy orders win the battle. But that's why I wasn't joining, buy side orders up there. I could see that sell side just slamming bids. I mean, I'm still, like I said, buy side bias and looking for a potential run to highs, but at that juncture in time, I didn't think it was a good trade. Pretty much everything down here was better trade than what was going on up here if you were trying to try something. So it's stopping right here, but it's not bouncing right here. Um, that often leads to a little bit of a sell-off farther, but it would make sense clearly that there would be support pretty much anywhere from 15 up. It's also coinciding with 12 half and 12 and three quarters over here, and the 30-year right here. 14, 15, 16. Now we're basically just in after after number, chop for the most part. I would I would think buyers would, come back in here at some place to support this, but it makes sense that you have a little bit lighter volume numbers pulling down, or the price is pulling down a little bit based off the number. again, I've waited a bit too long. This is a point now. I don't know, like typically if it gets back again on that kind of pressure, you don't run into the same type of wall, but we'll see what happens, I say, as it drops back in 2 ticks. Personally, I think it's very difficult to play this type of an area and this type of action unless you are willing to do some type of scaling and holding. Um, and I'm a little too far off to do that anyway. You could make a call to put on some size around 18, 18 half, or you could have probably done that when it was down there. And then if you were willing to average in, if the market then got down to 15 half, 15, 16, looking for ultimately an up move through the highs, but that's clearly projecting a long ways out, possibly. Um, so it's always, I mean, it really always is a question. I can't even classify it as high probability because the the general overall conditions would certainly be conducive to a very nice run through highs that could set off stop orders. But I've seen days like this in the past where all day long, it looked as though buyers were going to try to get it to the highs, and every single time they got there, it failed miserably. Um, and so if you want to ride out that kind of an idea, you obviously can't just step up and like this buy 20 halves and then blow out at 19 half, right? You're just giving away money if you do that. So if you end up getting caught up in this from the buy side, your risk is going to increase tick-wise. I mean, it's unless maybe I shoot for a breakout as it's happening, or I really think I see something, but um, I don't think it's an easy read for an all-in, all-out type situation. That's where I'm going with it. You know what I mean? So the some of the setups that I look for in terms of triggers, and entries, this really doesn't classify, even though there's lots of movement and action. You're kind of right in the middle. I would not step up and short 22. I mean, that's the problem. It's like I don't want to short 22 and get run over on a whirlwind up. But there's been so much stopping there that I've seen that before, and I know that multiple times people buy it up, buy it up, buy it up, and every single time you think, okay, this should be the time it goes, and it just doesn't for 2 hours. It'll do that, and it'll just never go. So like I said, where I'm going with that is the idea of being able to do sort of an all-in, all-out type trade and hit it, get an edge, and watch it run doesn't apply in this type of a scenario or in these types of conditions, as you can see. I mean, it's pulling back in again. So I mean, from a long-term perspective, it would make sense that the buy side would hold above 15, and so far it's been holding above 17. So it would make sense that if you're talking about a volume area that would hold, this should hold, and the market will probably kind of bounce back and forth and maintain in here. And then ultimately you'd be looking for a move through highs. But now we're projecting out into that realm of 20 minutes, 30 minutes, an hour possibly. And I feel like the probabilities lessen with each minute that goes by. So I guess why I want to share this is I want to share it so you understand why I haven't been involved in this mess, in this chop. B, if I end up getting involved, it will probably be to that effect. because the last thing I'm going to do is end up buying 19 halves and blowing out 18 half. You know what I mean? I would have to definitely buy in right around here on partial size, and then maybe average in again down here. But then, of course, if it goes through me to 14s, I mean, I'm just going to get buried. Um, it's about, though, the only way that I know how to play this based on the overall price action. And someone else also mentioned, yeah, the 30-year is way off the highs. That's true. It doesn't mean that they won't go, though. The 30-year has been lagging all day, and so since they were all back to moving in unison, pretty much going tick for tick or close to it, most likely, I mean, if the pressure builds and they actually tap new highs, all three markets will carry higher, most likely. But, as you see, I mean, trying to get back there and maintain it back there has been a bit of an issue for the buyers. So, particularly when you have the S&P now running for overnight highs. It's pretty sweet. So even looking at that, it's like even though I think buying support would probably come in around this area or around this area, I mean, if I'm watching an S&P shoot to, go through overnight highs, I don't really want to be long treasuries when that's happening. Well, that's the question. So wouldn't 17 half be good? I mean, under normal circumstances, if the S&P wasn't making a run for overnight highs, I might say yes to that. Um, I might think that 17 halves were a decent buy, but I'm trying to let it play out and not just throw out a bid there and then get run over as the S&P shoots up, to 87, 88. That's basically what I'm trying to avoid. And it's also a common thing in treasuries for there to be a very obvious level like that, and it ends up being a bit of a trap, and the market sinks through it by 3 or 4 ticks. So I'm actually more of a buyer, believe it or not, between 15 and 16 than I am at 17, 17 half right now. I think it's a difficult play. I mean, I guess that's where I'm going with it. I hate it when this happens, but I've seen this type of action enough to know really any of the easier money to be made if it was there today was earlier today. I think maybe playing in the slower moves, maybe doing a couple buy trades down here or selling it when it first touched 16 and scalping a couple ticks. I which I didn't do any of that. I thought that was hard too, but I think that action was easier to read than this, particularly once I started to see sellers come in. So I just haven't had a feel or a place where I thought was a very good spot in that mess to risk the money, essentially. And this is, what I mean is like, and we'll see if this holds true or not, but this looks so good from a buy side profile wise, but price action wise, it doesn't. That's where I'm going with it. It looks like too much of a it's too obvious, which I think they're proving me right now. It's just way too obvious to be a buyer there. So it's very easy for sellers to press through that and then work their buy orders several ticks lower and just sell it into themselves And because what they're hoping is that you have some buyers who are holding firm from 17.5 to 18.5, 19, and then those guys start bailing, on the way down. Um, and not to mention, I mean, when you got an S&P running on a consumer confidence number like this, looking for new highs, and clearly there's a bit of an inverse correlation taking place, obviously trend-wise, right? You definitely don't want to be long if the S&P makes new overnight, breaks overnight highs. So now we're trading 17s, right? So that I can't go short either. That's the problem. This is a problem with these types of areas and this type of action. I've seen this so many times. I know it's a trap to buy 17.5 or 18 usually, but I also know that if it does hold, it will go right back to 20 half. It's just, so there's not really due to the way the action is behaving, there's not really a way to get a feel for which way it's going to take place. It's very different than some of the other setups, that I teach and look for. It's just not my thing. Now, I may be, if it sinks, I may be a buyer down here. I'll have to feel it out, looking maybe to buy here, looking for it to push back to 17.5. But at this juncture, no way, not with the S&P as close to the high as it is. And I mean, they're holding the S&P. Clearly, I mean, they're holding the volume there. Hit some big orders here, sank back in, right? So it's holding, but I don't know how you identify an edge in this type of action. And what I would ultimately be looking for, on the downside anyway, is if it ticked down, which it's not at the moment, but orders absorbing and then buying back up, basically. So it sinks down in, and then maybe right away, if it hits 15.5, someone lifts 16 and 16.5, and then it pulls in, and they lift it again. Right now, it's just predominantly responding to what the stocks are doing. And if we look over here, I don't know, on the S&P side, I mean, maybe right here where it is, we'll see if the support holds in this area, but really it's about the same the entire way volume wise. So calling the actual price for entry is just difficult. I guess I'm rambling at this point, repeating myself. I just try to explain these scenarios as I see them, and that's part of the webinar. So people aren't wondering, why aren't you buying 17.5? Well, that's why I'm not buying 17.5. And that's the thing. It's like, I'm not saying the market, it's just, I have no call. I'm not saying that it's going to sink to 15 or that it's going to rally to 20. I'm saying at this juncture in time, I don't see how you identify an edge in terms of direction. And whereas earlier I was somewhat inclined to, like I said, you could cut size and work in an average. That went out the window as soon as the market hung at these prices and the S&P started looking like it was going for highs. I would definitely not buy in an average in here. You know, had I tried a buy side trade there, I would have already scratched it. Or taken, like, if I'd bought 18s, I probably would have blown out at 17.5. So here we go. S&P to new highs. Will it happen? Will it happen? I'm always tempted to play these runs in the S&P. You guys may see me fire off an S&P trade and lose a few ticks, but oh, 194, 205. Too slow. See, it's like if I missed that break, there it went. If I missed a pressure point, there's a pressure point. If I missed a pressure point, I don't chase. And I was too slow, way too slow. You gotta be fast. But that's how you can sometimes play S&P, breaks, and you catch a pressure point, then it shoots up, and then then bang, you hit out right here at 25 or something, and you scalp out 6, 7, 8 tick, or, hold it. But it moves so fast. And if you're wrong, you're losing 4 or 5 ticks. I mean, that's all there is to it. If I end up hitting the high there or near the high, and it doesn't go, I'm sunk. It's dropping right back to 84.25. But on the upside, you usually, if it does go, you get paid like that. It runs 6, 7, 8 ticks, and then you just hit it out as soon as it stops and cash in. So to clarify for somebody else, that's a pressure point right there. As it's breaking highs, it sweeps through on very light volume, like right here, almost nothing nothing in the red, only a 6 slot in the red there. I mean, it did kind of trade back and forth, but just kind of drives it up with very little hitting back into the bids, and then eventually, you hit more volume, like right there, right, 27, 24, and then you hit even more, 4,000, 3,900, 3,300. So clearly you have a lot more sellers willing to sell here than you did here. So now, from like my S&P standpoint, I don't really look for short trades unless I'm looking for a stop that pulls back in after the wave has happened. But you kind of look buy side unless it fills in that pressure point, which it may do, but that's the way that I typically view it. And as you can see, and now I need to jump back over to a market where I can control myself a little bit better. We have, as a result of that, what happens? Treasuries sink. Drop right through the 17 halves, right down to 15 half 15s. Now I'm, and if the S&P continues to move, it's still gonna drop in a little bit, but most likely we're going to see more buying support here than obviously we saw there, and they finally got through as the S&P jumps. I mean, it's not like this is what I talk about. It's not rocket science. I mean, that's just not rocket science. The trick, see, is like for me, I can't buy that because it's too obvious, and I see the S&P at highs. I can't sell it though because I can't tell what the S&P is going to do. So that's where I talk about if you're going to trade one market, trade that market. If I think the S&P is going to run the highs, I don't sell bonds. I wait for the S&P and I try and catch it at the pressure point or before the pressure point. You know what I mean? And if I miss it, I miss it. But I don't sell bonds in anticipation of that happening. It's too easy to get caught up going back and forth and do the wrong thing. Now, though, since the S&P moved up, I think it's a little bit easier to identify fade trades in the treasuries than in the S&P, because the S&P can like lift that 1700 there and just smash right through it by another 5 ticks, or it could absorb 1700 and refresh and then drop in 5 ticks in a matter of seconds, right? Whereas with the treasuries, even if they blow through that 1700 and I'm long, the market's probably only going to tick against me 1 tick. So, and I can sort of feel it out a little bit and see what happens. You know what I mean? And well, it's already bounced back up. I'm sitting here running my mouth. I'm trying to explain the thought process there. I mean, there you go. So it's very logical. S&P is near highs. There's no point, and you can see the trends are inverse between S&P and Treasuries. There's no point in buying Treasuries, even if you see a profile build up. In a profile state, there's just no point in doing that. Stand aside, wait to see what happens. Now it sinks down. It hits the next profile step after the S&P has broke highs. Makes sense, because people who are buying down here in the S&P would now be liquidating up here. You kind of pulls in, and then it's much more likely that your buy side in the treasuries will hold up at the second level than at the first level. It's very logical. Yeah, so someone's asking, is 86, 86.25 the pressure point? Absolutely. The reason being, that's your light volume. The market moves through those prices and encounters practically zero resistance. It just sweeps, and the only thing sitting there are the sell orders that are working. No one refreshes. No one hits back into the bid like they're doing here. Refreshing orders, refresh here, refresh, sell, sell, sell. Hit the bid, hit the bid, hit the bid, hit the bid, try and take it back down. Right here, no one's hitting the bid. It just goes right up, offer, offer. They sweep the offers, bang, 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 right? And I mean, it paused right there, and then it went bang, bang, bang again, and then it came back in. So you're a little bit far away from the pressure point now, so it's a little harder to make the call, but ideally, what your buy-side traders and programmers want to see now, or programs, is they want to see the buy-side hold above the pressure point. I mean, it's really that easy. They really kind of want to see it right here at 87 and above. If this market begins to get back to that pressure point and fill it in and trade between 86.75 and 86, now the buy-side will feel like it's lost all of its momentum, which it has. And now you turn into typically kind of a choppy mess back and forth, but you can't really have much confidence in buy-side pullback type trades at that juncture. Hang on a second. Let me see if I can step in front of this order at 15 and maybe scalp a few ticks here. So this is what I mean. So if the S&P runs, even if it does run, the market's going to tick against me. There's no doubt about that. But I get a little bit more of a look in terms of sort of feeling out the situation. As a contrast to that, I mean, one can also make the call to try and just hit this 1500 if it goes and hope the S&P runs another 7 ticks. But if it doesn't go, it's going to drop right back to 88.50, and you're going to be hung. I mean, no joke, man. It's so hard for me to trade that type of action when I see this. This is usually when I do go to the S&P, and I'll start trying to take buy side trades, looking for runs, because in the treasuries it gets really up there. Here I'm a little more inclined to be involved, but up there I just stay out because I can't tell. I don't know if that level is going to hold, or not. And I know it's kind of dependent upon what the S&P does. And so I just stop messing with treasuries and wait for things to develop. So for example, again, so right here, what these guys want to see for the most part is they do not want to see sell orders get back to 86, 86.25. If that happens, which is pretty close already, it's very easy for the complete buy side to lose all steam and sellers to pull right back into 83, and then it's classified basically as like a failed breakout, is what people view that as if you're using the technical terms. Yeah, I mean, but like if buyers don't step up here, probably going to kill the up move in the S&P for a while. And what can also happen, unfortunately, on this type of day is the the stocks and the treasuries appear to be moving. They're not appear to be, they are moving inverse to a degree. But as time goes on, that inverse correlation starts becoming less and less reliable. And so even if you end up making the right call in the S&P, it can be hard to profit from it in the treasury sometimes because they slow down and they don't move the same. For example, I mean, even right here, the where that breakout occurred at 80, 85, 75, 86, right? 86.25. When that occurred, the treasuries were basically where they are now. They were trading 17, 17 half, and then as that run went up, they sank to 15 half. Um, with that run completely collapsing back down, I would have anticipated that the market would, like the 10-year, for example, would at least be bid 17, printing 17 halves, which I mean, it may be here shortly, but it seems to be responding, in other words, in a much slower fashion than it was earlier. And that's what makes that correlation less reliable. Um, So when I begin seeing that the volume isn't as great and the response isn't as great or as fast. By the way, you see how that works? I mean, I'm trading the S&P is different. You know, you have to approach it in a different way, but it's just, I mean, pressure point fills in and then whoosh, right back down. They lose all momentum when that happens. You know, it has to stay above those points, and if it doesn't, they just lose all pressure, and that's it. Buyers give up, sellers take over again, and market pulls back into to the range. I mean, it's not a it's not that hard to identify. You just have to adapt your risk to reward scenario around it in a proper fashion. And you have to be really fast if you want to catch the breaks. But see, this is what I mean. So let's compare real fast. So at 9:30, when the market peaks out above 88, it shoots up, and you have the ZN kind of down here around 15.5. And now it's back where it started. But the thing is, that was a pretty big run in the ES. So that run up, I guess treasuries are responding. I mean, they are slowly going up, but it seemed as though they sank a lot faster when the S&P was going up than they've risen since the S&P has been going down. I guess overall it's a similar price. Anyway, whatever. I missed my buy opportunity there at 15.5 or 16. It's weird. This day is probably going to be a bust for me. Um, Pretty much any normal trader, when you see the market banging up like that, or as it did earlier, you don't want to step in front of that. Or I don't want to step in front of it. I mean, you're at any given point, pretty much, if you step in front of it, you would have been run over, with the exception of some brief action right around here. I think it hit 16s and pulled into 15s, two or three times, and then they just start ramming it up again. So I don't want to step in front of it, even though I see sellers smacking 21 halves and 21s. But I don't want to buy it because I see sellers hitting 21 halves and 21s. And it becomes a very difficult proposition from a high probability standpoint. And then it ends up pulling in after the number. And now you pull it into a level, but the level is not reliable because it's too obvious, and the S&P is going to break highs possibly. and then it does finally pull down to your spot, and that was my fault. I mean, I should have been a little more on and looking to work orders at 15 half or 16. Um, but now it's back to this point again, 18 half. And in terms of a call, I mean, where is it going? I mean, it's weird that a market can make a run like that to the upside and then just completely stall out and fail. No one's capable of taking it to new highs. So anytime I run into that type of price action, I don't usually make money. I stand aside, or maybe I scalp a tick or two here and there in the chop. But when it becomes clear that they're just failing on the breakout, I can't take a buy side in the chop, but if I take a sell side, I'm setting myself up for being swept if they do end up taking out the highs. It's just a bad scenario, and it requires more risk. There's just no trade in that range where I can get into a trade and risk comfortably know that a two-tick risk point is the correct point. I mean, anywhere in there, it just is not. That's not the case. Pretty much have to risk 5, 6 ticks in any of that chop, because otherwise you're just giving away money. You end up buy 20s, you blow out at 19, it goes to 21. You buy 21s, you blow out 20s, it goes 21 half. Or you end up selling 21 halves thinking you have it and it runs through you to 24s. It's just a kind of a, like I said, I think a person has to trade it from if you're going to trade it, I think you have to trade it in a scaling fashion, from a market maker's fashion, kind of playing the edges. Maybe working in and sell orders, and then, or you either flat out sell up here and just take your chances and blow out with a 3 or 4 tick loss possibly, or you end up buying everywhere between 15 and 18 and hoping the market comes back up to 22. But there's nothing happening in that time frame where you're really catching a trade that I'm going to hit it, and if it doesn't go, I'm going to scratch or take a 1 tick loss. I know that's the right move. It's just nothing that falls into that category. Or I'm going to hit it and lean on a big bid or big offer. Nothing falls into that category. And like I said, if you have a read on the S&P, just trade the S&P. Don't try to trade the correlation. Someone's even asking, is the S&P Treasury correlation over the last 2 days greater than normal? It's been similar to this for the last few weeks. Oddly enough, even like when the S&P was melting down, Treasuries didn't have that great of a response. So the correlation was not there to the same degree as it is now, which is kind of funny in a way. So it's been somewhat similar to this for the last couple weeks, but not as far back as whenever the meltdown occurred in the stocks. even now, I just don't see the play. I mean, at this point, even if had I been long at any juncture between these prices, I'd probably be looking for a place to take it off. Because it's probably going to be choppy in here. Um, 15 halves are money though. That was probably my only good call of the day there. Yeah, I mean, it all lined up at that point. Someone's saying it's 15.5 a decent buy. I don't say that in retrospect either. I mean, that was the one time I was finally kind of looking to possibly do something. It was based on everything I described, which was you kind of feel people get trapped at 17, 18, 18 half, and the market sinks. Well, the market's sinking because the S&P is running new highs, but this is your most logical next area of buying support. And it also happens to coincide with the fact that the S&P ran, created this pressure point that I was telling people, shot up, and then failed pretty quickly, right? So again, and if the S&P had hit for new highs again, I would have had to be careful. If I had, bought 15 half or 15 or 16, I wouldn't want to get run over too much there. But it all sort of lined up at that point. You stand back and let the market sink past 17 half. It hits the next logical support level. That coincides with the S&P liquidation area, which may then lead to a pullback, to the breakout. So if the S&P pulls back to the breakout, then at least your level should hold in the treasuries at that point, today anyway. And then if the breakout completely fails, treasuries should come back up to where they are, 18, 18 half. And you make a few takes on it. That's a very logical, well thought out trading plan that I'd failed to execute. But outside of that, pinpointing a really good buy or sell price in the rest of that stuff, I thought was very hard, which is what I was explaining earlier. And now I'm concerned that what we're going to see for the next hour is just heavy volume chop. Well, that and the breakout. I mean, I placed my order way too late, and the market had already shot 4 ticks past my order. You know, if you're trading the S&P, I mean, you just have to be fast. But that breakout on the S&P was certainly a legitimate play. If you're wrong, you're going to lose 6 ticks. But I mean, you obviously would have made that or more if you're right. It just makes sense though. I mean, it's coming up on a even, I mean, come on. A number comes out, market rallies all the way from 66 to 82, 84. That's your overnight high. When you're looking at those kind of, I mean, I'm not trying to talk technicals, but honestly, when you're looking at that kind of up bars consecutively, I mean, there's no point standing in front of it, Yeah, I mean, you got to figure that it's probably going to lead to a stop run. That's sort of what you're hoping, and you try to capitalize on that. And then when the stop run's over, you just take it, so you don't get caught letting it come all the way back to your entry price. I mean, in my mind too, so that's the real failure of most technical analysis strategies. It's not necessarily that technicals don't matter. I mean, obviously people are looking at bars and whatnot, It's more of how they approach their trade management and their risk. Too many people have you buying up here, and then they have you using a trailing stop, and the trailing stop is pretty much like where your entry is, and then you just get taken out. I mean, you completely miss out on taking advantage of the entire reason you were getting paid in the first place. Or they have you play a pullback. The market pulls back in, and now they have you buying at that break point, when in reality, as I was discussing, when the market actually gets back to the pressure point, I mean, if it's filling in the pressure point, you need to be out. You don't have to wait for it to go through the pressure point. You know what I mean? And you certainly don't want to be buying there. If anything, you're going to be buying in front of the pressure point, and then when it gets into the pressure point area, you just take the loss. You don't let it come back all the way into 82, something like that. I think that's where a lot of methodologies fail. Anyway, and so what do you see here? We kind of just getting back into it. What you would expect? It fails, it pulls in. Treasuries bounce off support, pull back up to previous high volume area, and now they're just sitting here. And I'm concerned that this is just going to die. May not. We might see something, but most likely we're not going to see. We're probably not going to see a run to the upside again. I mean, it may press up to 19.5, 20 again in some choppiness, back down to 17 again in some choppiness. But a run to highs seems pretty unlikely within the next 2 hours. I mean, who knows, afternoon-wise, something may change up on that, but all right, so someone was just pointing this out, and let me explain, because this is very important. If you just saw, there was a bit of an iceberg right here. It's like 4,000 plus, or 3,000 something on the offer, right? It has zero meaning right now. This is the context, okay? Icebergs typically only tip. Well, that's funny. Icebergs typically only tip you off. That's a tip of the iceberg. Anyway, I didn't mean it for it to come out that way. Icebergs usually only clue you in more in places like that, where if the market runs a level and then starts hitting an area, is what we were seeing up here. Actually, I was seeing it at 21.5 and 22 and 21. You've already had a run, and then the bids aren't really maintaining as strong, and then an iceberg absorbs, and you have the back ticking. That's when icebergs matter. Or conversely, there's an iceberg sitting at a pressure point type area, like maybe just underneath a high or a low, or at the very edge of a range, let's say. So maybe an iceberg is sitting right here at 15, right? And you got 4,000 on the bid. Well, if everybody can see there's 4,000 there, and sellers are still hitting that 4,000, most likely sellers are going to carry it down at least 2 or 3 ticks past that 4,000. So in that situation, I go against the iceberg, right? The iceberg is it's not hidden, because what happens on the upside is like the market's running up. Well, what's happening is buyers are now bidding and pushing in an attempt to push more buyers into their sell orders, but their sell orders are hidden. They only show a portion of them. So they only show 1,500 on the sell side, but they actually have an order of 4,000 working there. So they have a hidden iceberg that then shows up in the split prints as the market hits that price. And what's happening is you have a buyers pressing and then dumping into their own pressure that they've created, right? So that's typically when I look to go with the iceberg and do a fade trade. It doesn't always work, but it works enough, depending on the context and the situation. If the iceberg is showing too clearly, if it's a big order and it is absorbing, like I said, and maybe it's right there at like a little bit of a breaking point, a profile step, or a high or a low, and now you see 3,000-4,000 trade there, but you see no backticking, and obviously everyone can see there's an iceberg and they're still hitting it, then I typically go against the iceberg in anticipation of, like in this situation, sellers would take it lower, like I said. There's not an iceberg there now. I'm just pointing this out for reference material. Now, contrast that with here. It doesn't matter if the market goes up or down from here. It's not due to the iceberg. What happens is you get those runs, and then basically the market comes back to a state of equilibrium. And you have HFTs going buy, sell, buy, sell, buy, sell, buy, sell. You have spreader that may be working 2,000 in the 10-year and 1,200 in the 5-year. And so they sell, 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 buy, buy, buy. But it's not building into a position. That's something I try to explain throughout like all of my starter material. You had buyers take the market up. They got paid. They dumped. You had sellers get run over. They end up being the buyers, who blow out for a loss. So these short trades get run over, they lose. These buyers press the market up, they win. The market pulls back in. Now the majority of your open interest has been closed out. And so therefore you see what we see now, which is a market that's in a state of equilibrium in about a 3 or 4 tick range, and not much is happening. And that's because everybody's already made their moves. They either got, they got paid, or they got run over, or they were like me and couldn't make heads nor tails of it and just stayed out. And now it's all done. Which incidentally is why I typically don't trade afternoons, because you end up, anything that's open in the morning in a heavy fashion is typically closed out. And then it becomes a matter of whether anybody wants to come back in and play between, 12 or 12:30 and 3. Somebody's asking, did I say that people close out positions by 11 a.m.? Of course, people close out positions on a second-to-second basis. Now, I'm not saying everybody. Sure, there are some people that try to position for swing trades, longer term intraday trades. But I mean, you have to view it from a logical standpoint. Y- Imagine if you're a buyer down here this morning, even if you're a spreader playing the spread correctly, and you're on the right side anywhere from 9 to 12. Well, first off, those guys probably were out around 15 anyway, 15, 14, 13 half. They were out, and then things begun being reinitiated. Buy side guys start coming back in again and running over the sell side, predominantly and due to the equities, and they shove it, run it up, and then just push it right into their offers, which for whatever reason, and this is the funny part, they didn't have to step up there. I mean, if those offers had let up at 21, 21 half, and 22, if they had simply backed off, they would have, the market could have run another 8 ticks past that. But here's the thing, and I mean, this is speculation on my part, but it's not because I know how these orders work. The most likely thing that happened there is that there were some guys buying and they were kind of supporting the entire market, and they realized if they tried, no one was really coming at them, and so they were trying to figure out how to dump off these sell side trades, or the program was, whatever. So if in order for the market to go higher, that probably meant they would have to buy even more size up there, and this may not make sense, but you have to think about it. If you read some of those interviews with the flipper guy, he talks about working orders on both sides because he's trying to get a feel for what's actually happening. Well, what he means by that is, for example, let's say there's a bid of 2,500 here, and you're the guy bidding 2,300. Well, you're the only guy at that bid. You know what I mean? So if there's any kind of pressure and you're the only guy at that bid, you certainly don't want to just leave your bid sitting out there. You're going to get run over. So what he would do is instead he would end up he may be the only bidders at 15 and 15.5, or not the only, but 85% of the volume at 15 and 15.5, and he realized that, and so he would short at 16 half, 16, and then just pull his bids, and then the market would sink on that. So if you're moving that kind of size. And by the way, I am watching this, but I mean, there's not really a call to be made. If you're moving that kind of size, and now you're pressing up and you're buying 1,000, hitting 500, buying 1,500, at some point you have to figure out how to dump that. Well, maybe along that buying path, there's 4 or 5 trading desks that realize they're the majority of the buy side, and they can't commit to trying to buy through new highs. So what they do is they do a pump and dump. It's a mini pump and dump. They buy the market up. They've already been buying from down here, so they're already in the money. So now what they do is they buy it and bid it between 16 and 18 half, hoping to encourage a run at highs, which they did. And then new buy orders flood into the market based on that, HFT in smaller quantities, and when that happens, they dump into it. Well, then the HFTs all bow out, and they're like, wait a second, what's happening? And they wait, and then these guys come in again, they pump and dump, pump it up, bam, 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 buy it, bid it, and then HFTs come in, smaller orders, react to that, boom, 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 and then they pump and dump it again, bam, bam, bam. So it's a strange thing in terms of how it plays out, because had there been, I think, a lot of people interested in buying and supporting the market in this area, I don't think you would have seen those sell orders there. I mean, why are you going to dump off 8,000, 9,000 contracts when you're right near the high, and the market, if you just let up on it, the market would shoot up another probably 5, 6, 7 ticks. Well, you're probably only dumping it off because you're the guy buying up here. And you realize, I can't make this happen on my own, so let me figure out a way to work out the size now. I know it sounds funny that I'm talking about one guy doing that. I'm not talking about one guy, but we discussed this yesterday in terms of how many companies actually do most of the volume. So I think that's probably what happened. Or somebody was getting run over, and had the capital and the courage to just try to cap the market. So this market was running over, and maybe you had someone selling 15s and then selling 17s and then selling 19s. And finally, these individuals realize if this breaks highs, this is going to go against us in a big way, probably. And they just sell thousands of contracts up here in an attempt to cap the market and stop the up move and hope they can put a halt on it and bring it back in so they can work out of these trades for a much smaller loss or perhaps even break even. And this is where you and I are in the dark. We don't have that amount of money. We don't have that kind of capital. We can't trade that kind of size. And so all we can do is sort of go on what we're seeing in the moment. But that's the problem. It's like I can see a guy is absorbing at 22 and 21.5 and actively hitting 21s. But I don't know how much size he actually has to hit with. He knows exactly how much size he can dump on the market, right? So that's where when you think about what we're doing, it's a little bit crazy, but I see an order absorb for 3,000-4,000, and then the guy slams 1,500 back into 21s, right? And I go, that's interesting. I wonder how much size that guy has left. Does he have any left? I don't know. All I can do is react to those orders. If I knew he had another 8,000 to dump there, I would obviously be joining the iceberg and stepping in with him. You know what I mean? But I can't see that. Only he can see that. So we're attempting to make some educated guesses about exactly how much size is really sitting there. And is this a guy who's trying to cap the market? Is it players who are pumping and dumping and liquidating? Or, is there really enough buying power here to get through this? Is this maybe only a one-time order where a guy dumps off 4,000 and it pulls in 2 ticks and then he's not there the next time? So they have that information, and it's valuable. It's extraordinarily valuable. And that's why, Paul Rotter, the flipper guy, he wasn't working for, he was on his own at one point, but he wasn't even as big as some of the biggest guys. I guess he was probably maybe the biggest guy in the Eurex markets. But he would try to feel that out himself and get a feel for, all right, if imagine if you're a guy and you buy 2,000. Right away, you know that buying 2,000 in this market is going to take the market bid. So you already have that amount, that working for you, okay? And if you'll listen to my starter video, Fact versus Theory, I discuss how myself and another guy used to take advantage of this type of information a little bit on our own back in the day, before the markets became much more liquid than they are now. Hang on a second. Let's see what happens here. What a job they did on the buyers, huh? The breakout buyers there in the S&P. We'll revisit this in the Q&A. I'll come back to it. I'm not expecting a lot here, but it is possible that because like I said, not a lot of people watch treasuries, but everybody watches stocks. It's possible that if that break in this run completely fails and S&P begins tanking again back towards 74, we could see it bomb out today again, and this could actually go for highs. So I'm not saying that's going to happen in the very near future. But I'm going to sit here for a second and see if there's maybe an opportunity to catch an edge, or if any kind of momentum does start to present itself. I mean, I don't think necessarily there's going to be a great entry here necessarily in the next 3 or 4 minutes, but um, the fact that they did hold very well at the main volume area down here. They're now once again holding above 17.5, 18, and again clearly S&P is it made another run up and failed miserably and is now tanking. Obviously has a lot to do with that. So I'm kind of revolving it more around the idea of yesterday's sell-off in the S&P was pretty massive, and in case you haven't figured out, I'm a complete bear on stocks. I mean, if I ran a hedge fund, I would have already been short half of my available capital. I mean, I would have been short about 1980 or 1960 and just refused to budge. But that's a different ball game. A completely different style of trading. Um, so if we end up, we may even stay a little longer today, and we'll kind of feel it out. But if the S&P starts going into a tailspin again, going into the afternoon, treasuries are going to make new highs, almost certainly. So, which it may not take till the afternoon to do that. I mean, it may happen. We may get a run in the next hour or so, or it may just do this. Don't know, but I'd kind of like to be looking out for it, and on the off chance it happens, see if I can find a decent entry price, not take too much risk. And ultimately, what I look for, even in like slower action, uh, such as this, if you just saw that, you could see how they buy 20s, they print some 20 TAFs, but then immediately sellers come back on 20s and 20s go off again, right? What I start looking for, and now they buy 20 halves. What I start looking for is an area or a price, hopefully, where when it goes bid like that, it's not 400 on the bid. It's a little bit stronger, and the market doesn't come back on the price. Interesting. Oh, look at that. Well, I cleared that right out. I may actually take a shot at this, even though it's going to be slow, unfortunately. There they go. They hit it. So you see there, I mean, buyers are attempting to support this. And that's kind of what I look for. I mean, it's still a little bit dangerous, I'm not going to lie. But when you're looking at like a slow grind of this nature, you want to see it pretty much move a tick. And it may go back and forth like it is, but you don't want to see it fall back in now at a 20 half or 20. That's what you don't want to see. So when you begin to identify a spot where maybe it ticks up, kind of maybe trades back and forth, but it doesn't back up a one more. And then it ticks up, and then maybe it goes back and forth, but it doesn't tick back again. And like it's doing right now, unfortunately. But it's obviously reacting again to the S&P. That's what I look for in slower areas. Sort of every time it ticks in one direction, it fails to back tick too. like tick up, doesn't come back. Trades, tick up, doesn't come back. Trades, like that. Hold on a second. Possible that I may get sucked into a bad trade here, but that's the kind of stuff that, like, you'll also notice, even though the S&P had a little bit of a pop there, bonds stopped pulling in and jumped. I'm kind of leaning on this as well. Obviously the 5 year is going to have to get through those prices, but this is a bit different scenario than what we were seeing this morning. My goodness. And of course, I mean, you never like to see the bid pull away that fast, but sometimes that's a little bit of a lure type situation. So right here, like, and it's no, it's not maybe necessarily the greatest trade. I hate to talk myself into doing something stupid, but if this holds, the whole key right here will be if this holds. So if this doesn't really downtick another tick beyond here, like you see how they pump the offer up and then it trades down, but then the bid absorbs. It might be a little bit of a lure on the buy side. Then again, I may be having hopes and dreams. You know what I mean? I sort of look for that when I see like abnormally large offers. Um, Although they are selling off here now. And what I mean by the lure is the bids pull away pretty easily, like they have been, and then which it may not be, but they pull off, and then the market very easily falls in. The reason the market easily falls in is because you get some of the the programs. Anything that's long 21 is going to scratch 21. Anything that's long 20 half is going to scratch 20 half, or take 21s. So bids pull away, some size pulls it in, and this is if I'm right, this is the anticipation, is that it will drop in like this a few ticks because the bids are pulling off, and then buyers will hit it again and lift it back 4 ticks, from here, and maybe try highs. I could be completely off about this. It's not a really reliable read at the moment just because the S&P is so erratic. Excuse me. But that is a tactic which you see like that. I missed it. Just like that. I hate to pay up after seeing it drop down to that level, but just like that. But you never know if it's going to pop it back to the previous, resistance, or if they eventually are going to try to take new highs. Um, Interesting. So again, this is where trading size. Hang on, I should have already been in this trade. Should have already been in this for a free look. This is where trading size is an advantage because some guy out there knows whether or not he's going to be willing to trade 2 or 3,000 into new highs, or whether he's going to dump off 5,000 contracts right here at 22 and 22 half, right? Meanwhile, I'm trying to make an educated guess about what I think will happen if the market makes new highs and whether or not there will be power behind me. But did you see that little play there? I mean, you have to be pretty quick. And I mean, it hasn't popped far, but it's just one of those little edges you can find in the treasuries. It's like the bids pull off, market falls in intentionally, and then buy it, buy it, buy it. I can't bring myself to buy 22s. I have to wait. I have to see them going for 15 fives and 15 sevens and 22 halves and 23s. I may end up being hung at the exact top, but there's no point in buying 22 if that's the actual resistance level. You know, you see it, and this is how that typically they work when they. It's called the shake, or a shakeout, and there's no way to know for sure ever. Unfortunately, usually, I mean that S&P run looked pretty solid, but um, it's like even if guys are willing to lift offers, they're not going to try to tip their hand. They're going to try to get better fills down here, and when you're least expecting it. Oh, shit. Take a shot at 22.5. Hang on. And naturally, there's size absorbing. And nobody goes for 23s. See that? 0 stop orders hit 23. That is terrible for me. Absolutely terrible. I'm only in this because I see the 5 offer pulling away, but I see nothing touching it. There we go. Pop. There's a stop order at 23.5. Nope. Right back on 23s. Terrible. Incredible. And so, like, now I'm in a situation where basically I have to scratch that trade. It just, if I'm not, this is the disadvantage. Well, now they popped it. I got to keep on trading this and watching this. This is why you want to be in before the market gets here. This is what I'm talking about. If I had been playing a trade down there in that little lure type setup and been long, I guess it was right here where it stopped. So even been long, say 21s. I could sit for a minute, feel it out, and wait and see if it's going to go. I have a little bit of an edge there. But as it is, if I'm wrong about this, I'm at the absolute worst possible price. Well, this would be now 23s, but there's a complete lack of stop orders at the moment. That's the thing about this. It's the shakeout that I'm talking about. You really need to be positioned already so that you don't find yourself in a scenario where you run into a wall and you have bought the absolute worst possible price. And I mean, I anticipated this coming as it was. You know what I mean? So there's really no excuse. For I needed to be in somewhere below 22, really below 21.5. Anywhere between 20 and 21 would have been fine. And now I have a little bit of an edge, and I could feel it out and wait and see. As it is, I certainly don't want to go short here, because I know how shakeouts tend to work, and I know that this is how it is. Like, no one just comes in and buys 4,000 contracts and drives the market higher. You know what I mean? Because they don't want to be the one paying up. And so what ends up happening is if you try to take a shot like right there, like I did, if buyers don't immediately come in behind me, it shows weakness on the buy side. But the weakness might be feigned weakness. And I mean, even here, like now, I would have to, like once it falls back in, I mean, I'd have to take to get out, even if I'd bought down here. It's like feigned weakness sometimes. And by feigned, I mean like FEINED, I think is how you spell it. There are actually buyers here, perhaps, but they allow the market to just ease back in again, and they buy a little bit more, and then they let it come back in. They buy a little bit more, can buy a little bit more. And granted, it's responding to the S&P again, like I said, but um, so it's not until the third, fourth, fifth time when everybody who's been long has thrown in the towel and they're like, I'm done, I can't stand it anymore, I'm out. And then that's when bap, 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 through the highs. That's called a shakeout. So you can see that was the right play on my part. And at the moment, I mean, in the junk, at that point in time, the way that I play those trades is simply I go for it. They're lifting. The offer's pulling. 5 years ticking up. It's got to go. Because it's slow. Like, this isn't the fast market, so it's a slow. So it's not going to be like a lot of bit and then get run like the S&P. If it doesn't go, there's nothing I can do about that. And I just sit and I try to give it a few seconds and see if I can get paid. And if I can't get paid, I just take the scratch and, mumble to myself. No, I don't know. Actually, I don't really do that much anymore. Well, someone just commented, okay, well, why not be short right now if no one wants to go for the new highs? Did you really want to be short at 23? I mean, that's all I'm going. I mean, you have a market that's trading at the highs. It's finally pressed through the top of the profile range here. The 5-year is actively making a new highs. Are you really going to step in front of it? You know what I mean? I'm not. I'll take a buy-side trade. It doesn't go. I'll scratch, and then I'll wait and see. But once you've seen it come back in, it's already backed off 3 ticks. So do you really want to sell 21 halves here? You know what I mean? And maybe you do, and that's cool. More power to you. I don't like to sell the absolute top of the overnight or sell new highs that are just above the old high. It's just a very easy way to get caught in a sweep. The starter video I have called Don't Get Run Over by a Steamroller exemplifies this concept. Because I could have scratched there and it could have traded back and forth for 2 minutes and then it could have swept up 4 ticks. I try not to fade that kind of upwards pressure. As it is falling back in. I mean, what am I going to say, But in the moment, I can only make the best educated decision that I can make. And I'm certainly not going to be selling 22 halves as the market is buying, as they're bidding and buying 23s, right? So I can only be on the buy side if the pressure is to the upside and they're going for new highs. If it fails, I can make the call to scratch the trade like I did, or take a small loss, 1 tick loss, or 1 tick winner maybe even. I'm not going to hold that trade and watch it do what it's doing now, fall back in 5, 6 ticks on me. But I know that I may scratch and the market may bounce around here, and then they may uptick and uptick again, in which case I may go for a buy again. If buyers really come in again, I may try the buy side again. I don't take short trades at the extreme if it's already been established. It's like I said, if there's already been a wave and new buying has occurred, like we saw in the S&P, right? I always make it quick in a chart. If the wave is there and I see him failing to go for new highs, sure, I'll take a shot, and if I get run over, I'll blow out quickly. But right here, if that's the high and that's the high and the market is there again, no way, man. Because that happens too easily. You just get thrashed on those sweeps. You think you have a 2 tick stop in and you end up losing 4, or more. So But had I stuck with that game plan when the market pulled in a little bit, looking to buy, I would have at least made a few ticks. If I had been long 20 halves or 21s, um, even 21 halves, really that's a little. I didn't want to buy 22s, but you watch it do that, and now you're 2, 3 ticks in the money, and now it fails, and now it fails, and then when you see it's going to hit 22s, you just sell 22s, and you'll end up scalping, you know, 1 or 2 ticks on the trade. So at least you come out a little bit ahead, and you had the free look. You were 4 ticks in the money, getting a free shot at possibly another 4, 5, or 6. But when you're playing, because that falls under the category of what I describe as she goes. And when you're doing an as she goes type setup, you're always on the cusp. You're in the danger zone. You know, um, you're always running the possibility of hitting the worst price if it holds. Excuse me. And again, I'm not suggesting anyone do anything. If you find out that maybe your style is you can figure out from a context standpoint, usually when it's not going to go, and you want to step in front of that, more power to you. You know what I mean? Um, Possibly you can make that work for you. I tend to just not like running the risk of being swept in those areas when everything is pointing to the upside. Um, I don't want to step in front of it, and if it does fail, you don't know it fails until it's already retraced 3 or 4 ticks. And so I certainly, if the market stopped at 23, I don't really want to be selling 21 halves usually. You know what I mean? That's a little bit too far off in this scenario. I'm going to step away for 2 minutes. I'll be right back. Alrighty. So, these areas, this is, like I said, I was kind of concerned. And I mean, we did see a little bit of movement there, but it could very easily die 100% now. Um, what's this guy doing? Yeah, so the ES backed all the way up, so, and very choppy in here. There's not much in the way of reliability at this standpoint. Um, I mean, we do see some big orders right here in the 5. Whether or not they're really there is questionable. I mean, sometimes people place out those big orders because they're actually selling, and then they pull them away, and the market comes back in. Uh, Sometimes I'll step in front of those types of orders if they really appear to be holding. But, you can see that one drop down very easily. Um, Selling the 10-year right here at 20.5. What I will say, well, something that's very noticeable is that we see, um, at least in the 10 to 5, we see sort of 20 halves and 21s. It's stopping there now. You see a more volume trading here, more volume really trading here at 14 half. That's no guarantee the market's going to stop there by any means, but if it stays at that level for a while and can't seem to trade below it, then your buyers may come in and, if not take it to highs, they may take it back to the high. That's sort of a common thing. We may see this fall into a bit of a range between 20 and 22 again, 22 half, or it might see the 5-year fall into a range between 13.7 and 15 and a quarter. I mean, those types of areas, you're basically just making a, if you're taking a shot, you're just taking a shot. You can see it holding. You, if you want to put the bid out, you put it out. If you get run over, you get run over. Um, Kind of, or in the 5 year, you just sort of lean on the big bids that were underneath right there, 14 half, 14.2. And taking it right back up. Excuse me. Oh, and now they try it, of course. Extremely frustrating. I don't even want to, it's like they're lifting it now, but trying to make this play now, it's, again, am I running into the exact spot where there's a wall? Which probably won't be. It'll probably pop another four ticks. Um, the question, the question always is, and why didn't the buyers do that last time? You know, uh, so I mean, at this juncture, you know, I mean, all I do is I've missed a break basically. I'm not real eager to do anything at this point. Again, I feel like it's been doing what I've been anticipating all for the last 2 hours finally, but it's certainly not running on mad volume. However, if I try to step in front with a short trade, I'm stepping in front of something that I foresaw coming a long time ago, and I think it's just too easy to get run over. Crazy. Naturally. and then you hit a little bit of selling and back ticking. By the way, that's why you don't short the exact highs right there. I mean, I know, it didn't happen earlier, but it's, you're just, if you toy with the idea of selling highs like that right at the edges, you're just inevitably setting yourself up for those kind of moves against you. Um, and then you blow out right where it turns around and drops back in 4 ticks. You know what I mean? So I'm always trying to avoid that in these types of days. Oh, and I would have been out as soon as I saw it come shoot back down. So what I'm looking for now is to see whether or not they sustain at some level here, and if possibly a small range develops that might be able to be played. Um, and see, you like if you're new to treasuries, you don't have to feel for the context of or the behavior. See, that's not really normal even with this whole day. I mean, I've made some overall big picture reads on it that were accurate, but it's not really that common, and particularly even like that kind of a thing. Usually when treasuries break highs like that, they don't immediately fall back in 4 or 5 ticks that easily on light volume. There's typically a little bit more volume sustaining 2 or 3 ticks below the low or below the high there. So this action is just very, very tough. Um, I mean, see, it's fairly light volume overall. I mean, there is volume trading, but the way that it's moving is fairly light, like 4 or 500, then goes up, and then 4 or 500, and then 7, 8, 900 pull away, and then 3 or 400 trade, and so it's hard to get a handle on whether or not there really is any pressure in either direction, or now we're in the land of HFT zone. Yeah, I'm contemplating actually a short, but I don't again want to step in front of something like an idiot. Um, because I can see how easily this market's being swept on light volume, and that can be really dangerous. You all see what I'm seeing. I mean, obviously, when it first hit here, it stuck, pulled in. I don't know if that's going to happen again. It seems to be failing at the moment to sweep new highs. But we also see, I don't want to point to it at the moment, but we can see, that's sort of our stopping point. It's stopping at 25, 25.5 on the downside. Um, Stopping at 17 in the 5 year. So this is when I talk about kind of a tight range possibly developing. Yeah, I thought about it too long. Well, I thought about it too much. I mean, you basically just, if you're going to make the call, you just got to do it. Uh, Part of my problem now, too, is like it's afternoon and I'm not, I haven't really made any trades today. And so I'm not free rolling. I'm not up any money. I missed the breakout when it finally happened. So there's an iceberg on the offer, but if it doesn't hold, that's one of those situations where that should happen. Basically, it should be ticking down after that. But if it doesn't hold, then I typically go against that iceberg, meaning I would take a buy side trade at some point right in here. But if it does hold and ticks down two or three from there, then it's like game over. I mean, I give up. Um, right here, I really have no thoughts. It's moving so slow that clearly, I mean, I think you can see, for example, when it finally went for highs, um, or when the S&P made highs earlier today, you see how those are the ideal scenarios. If you can get on board in that kind of a break, or if you even, I mean, if you can find a spot that's holding and the market doesn't move against you very far, whether it was 20 half here or whether it was 16, 15 half down here, you're trying to find these areas where getting paid is not that hard. And so the problem with this type of an area is, again, you're back to where you're, like I mentioned yesterday, you're at the whim of the next guy moving 800 contracts. You can't really get a feel for overall movement or anticipation now because the breakout's already occurred and the breakout immediately ran into liquidation right here. Boom, 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 right? So, I mean, the breakout was just right here at 22, 23, 23 half, and then ran into stops or, selling pressure right here from 26 half down. So now you're right back in the middle of that. You're right where the break occurred. You don't have fast action. You don't have heavy volume. You don't have a continuous flow that I'm always talking about, right? I mean, you see not even a one lot has traded yet. Waiting for the one lot. Somebody print up. There you go. Finally, somebody hit 40. And then they lift. So ideally, you want to be in places where, when they lift a bid like that, immediately 2 or 300 hit the next price. It doesn't always happen that way. I mean, you have to sit sometimes through like this area was right here or whatever. But when making a decision as to whether or not you want to play in the game, that's typically what you want to see. At least that's what I want to see. And I feel as though the few opportunities I did see today, I just flat out missed. So the idea of risking money now on a trade is just silly to me. Pretty much, it's if you don't take the trades that you did see, or if you try a few and you don't get paid, you know, sitting here forever and trying to force it in something that you don't consider to be good action is just pointless. it's frustrating because it's that classic shakeout action that I was describing, and I mean I've seen it a million times, but I know that the way that you have to manage it, you just have to stay long all day. You know, I mean, which doesn't really work all the time. So it's interesting how larger players can do that. They can pump the the buy side up to those levels two, three, four times, and then just turn around and then just go the other way and bring it back down. And they do it so many times that everybody gives up on the buy side. And they're finally like, fine, done, I'm out, I give up. And then that's when they finally run the highs. I'm still here. I was just going through some questions. Um, I don't think it's going to be very conducive to gaining an edge or making a good call that's going to have follow through, etc., stop orders, whatever. I mean, so you finally have the 30-year back at its high, but now you have the 10-year a little bit off, the 5-year a little bit off, uh, and you don't have that continuous flow that I've been talking about. And even though the market's holding there at 24.5, 25, don't know for how long that will hold. Um, and you have the stocks sort of in a chop type situation also, you know. So I'd like to just go ahead since we're here. We can do this Q&A and knock it out and then call it a day. Give me just 1 second. Okay, let's go through some of these questions here. Um, Question. You said pressure points, a valley. Well, okay, so this is misunderstanding number one. A pressure point is not necessarily this is just terminology for describing price action. But the question is, you said pressure points or valley could be used as a resistance point in order to go with the initial trend. But in another video, you say it's not a good idea to enter just before a valley because there's nobody behind you. Could you clarify? So, uh, pressure points inevitably are valleys, for example, like right here. But just because there's low volume there doesn't necessarily mean it was a pressure point. There may have been a time earlier in the day where the market just sort of moved through it easily and came back a little bit and then went up. But when you're looking at pressure points, you're looking at what we were looking at with the S&P this morning. They snapped a high, very light volume was on the offer side for a couple prices, and then the market ran higher. So the idea there, and it's similar to what we're seeing right here, as a matter of fact, is a market breaks to new highs. Our previous high was at 23. It breaks 23.5, although it was sort of back and forth. And then it moves up, and then it stops, and then it pulls back in to where that pressure point was. But you see buy-side action supporting above the pressure point. As long as you see buy-side action supporting above the pressure point, as long as I see that, I remain biased to the long side and will sometimes take a buy-side trade right in that area. Hang on a second. I'm going to take a short trade right here. Or maybe not. I mean, you see how there's nothing there? The entire offer pool is off except for 300, but not even a one lot prints into it. This is what I mean by like bad action, um, and lack of a continuous flow. Yeah, the moment is just a grind. And so maybe at some point here in the next few minutes I can spot a price that's really holding, go for a short trade that may lead to a pullback. Um, the buy side is pretty tough considering how heavy the selling is right up here. But even though they're not buying through highs, they're not pulling back in either yet.